mind. Let's get straight to the floor show. Joining us this afternoon, Dryden Pence. He is the CIO of Pence Wealth Management and Slatestone Wealth Chief Market Strategist. Our good friend, as always, Kenny Polcari. Gentlemen, thank you both for being here. Kenny, let me begin with you. Obviously, the big story this week is the CPI, the PPI. We know that the Fed is going to be looking at this very closely. What are you expecting? If it's hotter than expected, I would imagine you're going to see some running for the exits and the markets go down, right?
Yeah, well, I expect it's going to come in slightly hotter, not tremendously, but, you know, of a percent to continue the trend that we've now seen for 3 months in a row. So I'm not going to be surprised if that happens. And quite honestly, I'm not necessarily sure the market's going to be that surprised, but I would expect to see us pull back because that would just, once again, not support the rate cut narrative that they continue to try to tell everybody is coming. Now they're not even saying June or July anymore. They're just saying it's coming by the end of the year. So they've conceded the fact that it's not happening anytime soon, but they're still, you know, they're bent on the fact that it's happening. I'm still in the camp it's not happening, that I do not think we're going to see a rate cut in 2024. So a pullback would actually be welcome by me. I'd love to go shopping when things are on sale.
So Kenny thinks it's a little frothy right now. Dryden, let me bring you in. I found this interesting. Analyst at Morgan Stanley said that the U.S. economy is cooling down and is predicting 3 rate cuts, one in September, one in November, one in December. Is that wishful thinking? What say you?
I think it's a little wishful thinking. I think we're probably more in the 2-rate cut camp and really leveraged to the very end of the year because I think basically the economy has moved from a torrid pace to a sustainable pace, and we're not really seeing a lot of movement down. So we get a little pullback on inflation. It's just in the direction that we want. But I don't think the Fed's got room to cut 3 times because I think they're at risk of reigniting some things. And so we're in the camp of maybe we get 2 rate cuts, but they're very, very close to the end of the year.
All right. Well, what areas do you like, Dryden, to follow up with you? We see that tech, again, has been strong since the beginning of the year, but anywhere else that you like, or is it still about tech?
Well, I think that you talk about the Magnificent Seven, but we really believe in the 493, the whole rest of the market. You're beginning to see earning beat after earning beat after earning beat, and we're kind of moving this where the rest of the market beginning to participate. We're lofty on the S&P, but that's only because you had 7 or 8 companies really push it. So if you take those out, you really have an S&P that's got a PE ratio in the 17, 18. So it's got a little room to move. We like the 493 because we think that earnings are going to be good and that we're going to see companies continue to do very, very well in this environment.
You know, the earnings have been good, Kenny, but you could argue that the bar was set so low that maybe it's not as accurate a measure of where the companies are.
Well, isn't that always the argument, right? That they lower the bar ahead of the earnings season, so it makes it easier to jump over. And then it looks like, I think, 96% of the companies reported and better than 80% of them beat the estimates, right? That's usually, it's a little bit ahead. Usually it's in the mid-70s, maybe 74, 75%. This quarter, it's better than 80% of beating the estimates. So yes, to your point, I think the bar was lowered, but I also good guidance from a lot of these companies was not nearly as bad as some people expected as we were moving into the earnings season versus now as we're moving through it. So I think the forward guidance was fairly good and decent, which is what has helped us to for the market to rally. But you know, I do think that tech has gotten a little bit ahead of itself. I think it's been that way for a while. So I'm not chasing those names, but other names, to Dryden's point, the other names at the 490. So whether it's consumer staples, whether it's financials, whether it's energy, are all, even utilities, by the way. I think utilities are up 7% so far year to date, have performed nicely. And so investors are starting to look further out of the, out of the center to help build their portfolios.
Right. So that said, Kenny, very quickly, Dryden. So what do we do? Buy in May and not go away?
I think you basically lean into this and continue to recognize that the market's got a little room to run. We're running through the rest of the year. The beat goes on as you take a look at earnings. And, we had this earnings recession, and so we kind of moved from a rolling recession to rolling recoveries. And you're going to see this on a company-by-company basis. So I think that we're actually continue seeing things on a company-by-company basis moving forward through the end of the year.
Yeah. I would say that's all very bullish, given that we're so dependent on the Fed, of course, and what's happening with inflation. Gentlemen, thank you both. Dryden and Kenny, appreciate you being here. Move on.